U.S. exceptionalism. It's a term that's been pervasive over the last couple of years due to very strong economic growth in the U.S., low inflation, impressive profitability, and a solid labor market. But increasingly, people are questioning this narrative. Sell America, end of U.S. exceptionalism. Questioning the political uncertainty, high debt and deficits, a weaker dollar, higher rates. However, the U.S. has a long and storied history of innovation, profitability, and enduring markets. So this is not the end of U.S. exceptionalism, despite some of the headwinds that have been appearing. So today, I want to talk about the past, the present, and the future of U.S. exceptionalism. And we'll start with the past. What U.S. exceptionalism has been built on in recent years is a 4-3-2-1-0 economy. Let's start with 4. 4 years of exceptional economic growth. What you can see on the left side here is that in that blue dotted line, usually the U.S. grows at around a 2% pace. But if you look at the gray line, more recently it has been growing at an above trend pace. For the last 4 years, extraordinarily strong growth coming out of the pandemic. What's been driving that growth? You can see on the right side, the main drivers of the U.S. economy. All of the 3 major actors in the economy have been firing on all cylinders. You have business spending in gray, about 15% of the economy. Businesses, despite higher rates, have been investing in AI, in productivity-enhancing tools. The government in green, both the federal government and state and local government, have been on a shopping spree. They have spent trillions of dollars, over a quarter of GDP over the last couple of years, on the Inflation Reduction Act, Build Back Better, now the One Big Beautiful Bill, the stimulus checks during the pandemic then went out to consumers. And consumers, the true backbone of the U.S. economy, about 70% of consumption, have been on their own shopping spree. They accrued $2.3 trillion in excess savings. And unlike in many other parts of the world where people squirrel away some of those savings for a rainy day, the U.S. consumer spends pretty much everything that they have in their pockets. Whether it's the cash, whether it's on credit cards, the U.S. consumer spends when the economy is looking good. The U.S. consumer engages in retail therapy when they're not feeling so good about the economy. But the reality is the consumer balance sheet is still pretty strong. Consumers have about $10 in assets for every $1 in liabilities. And that has improved in recent years. We've had spectacular home price appreciation, financial asset appreciation. On the liability side, for all of the headlines about student loans and credit card debt and auto loan delinquencies, the reality is about 2/3 of consumer liabilities are mortgages. And in the U.S., people lock their mortgages in for 30, even 15, 10 years. And a lot of those rates have been locked in at extraordinarily low levels before rates began to rise. So the consumer is in fundamentally pretty good shape, able to service the debt it has. 3 years of low and stable unemployment. Another factor that underpins strength within the consumer, even after all of that excess savings has been spent, is the fact that people broadly have jobs. If you look at the gray line here, we look at the unemployment rate over time. It's just around 4%. And if you look back over history, generationally, 4% is pretty low. Not only is inflation low, but it's been unemployment low, but it's been stably low. Around 4% for 3 years. Psychologically, think about what that does to the worker. The worker is the consumer is the worker. If people broadly have jobs, maybe they won't be on the shopping spree that they've been on in recent years, but they can still meet their basic needs and beyond. In addition to that, take a look at that blue line there. That looks at wage growth on a year-over-year basis. And while it has come down since the heights of the post-pandemic, it is commensurate with prior peaks in wage growth, so still overall pretty high. And it's been outpacing inflation for the past 2 years. So in aggregate, those wages are growing at a faster pace than prices and the cost of living is rising. All of that has been supportive for overall consumption. Now, recent data does show weaker jobs, but in the context of where we started, the starting point was very strong. So weaker, but certainly not weak. Softer, but certainly not soft. 2% inflation within reach again. It's easy to lose sight of the fact that prior to the pandemic, the US actually struggled to generate enough inflation. We were persistently below our 2% inflation target. And yet we went into the pandemic, and by the time we came out, there were multiple inflation pressures brewing. This slide here looks at contributors to our overall inflation at a headline level, and you can see that surge to peak at 9% inflation in 2022. So what caused that surge? You can see in green and in purple, commodity prices spiked due to the war between Russia and Ukraine. You can see in orange, core goods prices moved higher because of some of the supply chain issues we had. And then if you add together aspects of orange, the core goods, and light blue, services, that massive amount of excess savings that consumers were spending pushed up prices. And finally, housing really began to take off in 2021 into 2022, and that hotter housing market caused hotter rents. So it was the perfect storm of inflationary pressures across every area of the economy. And yet where we've landed today is that we've made tremendous progress from that 9% to around 2.5% today. You can see in many of these categories easing across the board, such that the complexion of inflation today doesn't look all that different from what it did prior to the pandemic. Now, this is, of course, yesterday's inflation, because we do have inflationary pressures coming from areas like tariffs. And so far, what we are seeing is that evidence of tariffs feeding into higher consumer prices is occurring within goods. You see apparel, appliances, toys, coffee, all starting to see a lift in prices. So where does this leave us in a couple of months' time? We could see a temporary lift in prices, but then that lift is likely to turn into a shift. And you're seeing that underneath the surface. As people spend more on goods, they may want to cut back on other areas. I don't want to go to the movies, a concert, out to restaurants to eat, maybe less international travel, so that I can save in other areas. You already see that blue area in that light blue that looks at services cooling off a little bit. So that lift in inflation will probably be temporary and become a shift in terms of what people are buying. As growth cools overall, inflation should cool along with it, keeping us on track to go back to that 2% target. And finally, 10. I cheated a little bit here. 10% profit growth in 2024. At the intersection of the economy and markets is profitability. And what you can see on the left-hand chart here is we look at the S&P 500 Broad Equity Market Index's earnings growth over the last couple of years. Very strong earnings growth coming out of the pandemic, but many people said, well, you have very low rates, you're springing back from a weaker base. But what's remarkable is the 10% profit growth that we had last year. Because in that environment, we had been experiencing interest rates at their highest levels in about 16 years. We'd experienced that inflation surge, which caused prices to be higher across the board. We'd also experienced less demand from consumers as some of that excess savings had dried up. And still, we had 10% profit growth. Now, underneath the hood, a lot of that was driven by some of our mega cap tech companies. In fact, about 2/3 of profit growth came from those companies alone last year. Margins have also been remarkably resilient. You have seen in recent years margins actually reach new records as opposed to being eroded by some of the challenges of rates and higher costs. Now, about 2/3 of that margin growth has also come from some of those high-tech companies. You can see areas like the Mag 7 with 21% margins, but the rest of the market still having 12% margins. Incredibly strong ability to turn innovation and sales into profitability within the US. So then why is everybody saying sell America? Well, there are clearly some headwinds afoot. Political volatility, lower dollar, higher rates, higher deficits. But I say not so fast. Yes, all of those headwinds are true, but there are some mitigating factors involved here. So let's start with political volatility. Critics may say the political environment in the US is going to undermine US exceptionalism. And certainly there have been changes in the political environment, notably tariffs, a newer policy that has taken a pretty big shift. So this slide here looks at the average tariff rate on imported goods in the US that went up from about 2% last year to about 30% in orange there in early April, now down to about 15%. Still very high when you compare this to last year, and represents a marked shift in trade policy in the US. And that will have impacts on some of the economic factors that have made the US exceptional. For one, someone will have to pay for those tariffs. Who will it be? Consumers or businesses? Likely a mix of both. We would estimate about 60% of those additional costs will be borne by consumers. Now again, if consumers are paying more for goods, they may want to cut back on other areas or eventually cut back on those goods. So while we could see a temporary lift in inflation, we could also see a slowdown in demand. Where companies are taking on those costs, that could erode those near record profit margins that we saw on the other slide. If we think about international impacts, certainly this does create some challenges from an inflation and growth perspective abroad in other countries as they are contending with these shifting trade policies. And yet, what we've seen so far in the data is that impacts from impacts from tariffs have been relatively mild. You are again seeing, rather than simply a lift in inflation, there is a shift where other categories are seeing less inflation. You're still seeing, based on some of the retail sales data we received this morning, there are some inflationary impacts in there for sure, but consumption still looks intact. If you look at producer prices, how much are producers taking on of these new costs? They were cooler than expected. And what we've been hearing from companies so far during this quarter's earnings season is that there is resiliency in demand for consumers, and they're still seeing some runway ahead for growth for their own companies. And that earnings growth has overall been supportive from a market's perspective. So we're not truly seeing massive impacts yet. Some of those impacts may continue to feed into the economy over the course of the year, but nonetheless, we haven't seen the economy shaken by the impacts of tariffs yet. Now, critics will also say the U.S.'s federal finances are a mess. If we look at the top right, we look at the deficit as a share of GDP. It's about 6.4%, which is basically double what it's been over the last 50 years. Now, for a while, people didn't really care about the deficit because it was being financed at very low rates. But now, rates have risen, and essentially, interest costs have tripled over the last couple of years. So how do we make some progress here? If you look at the left-hand side, we look at our 2025 budget. We are on track to spend $7 trillion this year. We either have to cut spending over time, or if you look at the second stack chart, raise more revenue. When we think about the passage of the One Beautiful Bill, it does cut about $1.2 trillion in spending over time, in particular from some of the entitlement programs. So you can see in the middle there we have Social Security, Medicare, Medicaid, other mandatory things like veterans benefits. Medicaid is one of the big targets from the One Big Beautiful Bill. The question is, will we truly see all of these spending cuts, or will some of them be pared back over time? And even if we are able to achieve those $1.2 trillion of spending cuts over the course of a decade, is it enough? Because when we think about the sources of financing on the right-hand side, taxes are our financing base. And yet this One Big Beautiful Bill Act also contains $4.5 trillion in tax cuts and tax extensions. So even if we think about raising more money from tariffs, estimates of about $300 billion a year could be raised from tariffs. And yet, think about how small a piece of the pie $300 billion is in terms of our overall financing. So the numbers don't quite add up when we think about the cuts to spending, the additional revenue from tariffs, but then the enormous additional pothole we have from the perspective of cutting and extending taxes. So where that leaves us on the right-hand side is we're probably going to continue to see deficits stay between 6 and 7% of GDP and potentially creep even a little bit higher. And on the bottom, that's going to continue to raise our debt to GDP. And yet, the One Big Beautiful Bill will also provide potential stimulus in the new year. In 2026, we could see higher growth because of higher consumption, some of these tax cuts boosting consumers' ability to spend, and a number of different corporate cuts that will help profits overall. In fact, the costs of tariffs could be outweighed by the benefits of tax cuts in the first half of 2026 before fading into the second half of the year. Critics may also say, well, the US only thrived for the last 15 or so years because we had ultra low interest rates, and they're not going back to 0% rates. This slide here looks at the federal funds rate, our benchmark policy rate set by the Federal Reserve over time. Currently in gray, we are at about 4.25% to 4.5%. What is the Fed waiting for when they think about additional cuts as they started their cutting cycle last year? They're waiting to see how policy plays out. Not only what policy actually is, but what is the impact on the economy. They do want to be sure that inflationary impacts are not sticky. And they're willing to watch and monitor that even as aspects of growth look a little bit weaker. But since we should avoid recession, they're looking to wait things out a little bit longer. So the blue and green lines look at expectations for where the federal funds rate goes. In blue, it's the Fed's expectations. They expect about 2 rate cuts this year, and that's been pretty consistent since December. The market in green has been all over the place, but has more recently come into line with Fed expectations for 2 more cuts this year. We're still in wait-and-see mode, but it is likely that the Fed will get to some degree of cutting this year, although perhaps less than the market may have expected a couple of months ago. That being said, when we look at the longer-term trajectory, and you get to that purple diamond, the Fed is headed towards 3%, not towards 0%. And yet, the last couple of years have proved that the US economy and markets, valuations, profitability, consumption, business investment, are resilient against the highest rates we've seen in 15 years and are able to withstand and thrive in a higher rate environment. So 3% doesn't need to be a headwind. We also don't require that 0% to thrive as an economy or markets. Critics will also say the dollar has plunged this year. And maybe this questions the reserve currency status of the US dollar. What we can see on the left there is the dollar over time, and it's down over 10% so far year to date, with a lot of that sell-off happening in the first quarter of the year. Part of that was policy changes. Typically, the US dollar gets stronger in times of uncertainty, but since a lot of that political uncertainty was emanating from the US, the dollar got weaker. There's also been various pressures on the dollar that have persisted for a while. You can see in the top right, the trade deficit. Pair that with the budget deficit from the other slide there. Those twin deficits should force the dollar weaker. And in addition, while the US hasn't been cutting rates as many other developed markets have, it should start to pick up the pace of its cuts in the back half of the year and into next year, which means the interest rate differential starts to narrow, and as you cut, you probably will see the dollar move a little bit weaker. You also pair that with potentially weaker economic growth. The dollar does particularly well when the economy is really strong or really weak and we're in recession. But if you're somewhere in between, that typically is an environment of a weaker dollar. So while we might not see the speed and the magnitude of weakness in the overall dollar, we're still likely to see the general direction of travel in the dollar move lower. But that doesn't necessarily undermine the reserve currency status, because we should keep in mind that on the left-hand side, the starting point for the dollar was very high, and the dollar has overall been climbing since the financial crisis. Safe haven flows, as interest rates started to move higher, all of these have been catalysts to move the dollar higher as well. Strong financial markets, flows into assets within the US. So we were overdue for a normalization in dynamics for the dollar itself. Now, when we think about the reserve currency status and how this dynamic might change it, the US dollar is so entrenched in the global economy and markets that even some of these challenges we've faced this year are unlikely to undermine its status as a global reserve currency. If you take a look at the chart on the right, you can see the US dollar's share of foreign currency reserves pretty stable over time at about 60%. The next most competitive currency in that category in gray is the euro at only about 20%. So it will be very difficult to unseat the dollar. You can see the same dynamic on the top right when we look at central bank reserve holdings. Again, around 60%. While it has declined over time, it's still been that dominant player. And then finally, when we think about how integrated the dollar is throughout our financial markets and throughout our economy, on the bottom it shows the dollar's share in global markets. About 25% of global GDP is in the US dollar. When we think about cross-border transactions, SWIFT payments, that's over 50%. International bank claims as well. We've talked a bit about FX reserves. If you think about financial transactions, derivatives, options, swaps, a lot of these are underpinned at least partially within the dollar. Think about trading commodities. In addition, that is very much underpinned by the dollar as well. So it will be very hard to unseat the dollar as a reserve currency, although, again, it could be moving in a slightly weaker direction overall. Now, some of these shifts, particularly the weaker dollar, have actually created some airtime for other global markets. And it's made us realize it's not just the weaker dollar, but it's the fact that there are a whole lot of interesting catalysts happening in other markets that are coming to the surface. And maybe ones we haven't appreciated over the last couple of years because the focus has been on US exceptionalism. So what you can see in this chart here is we look at returns across different regions over the last 15 years, in 2024 and 2025. And boy, the difference a year makes when you look at 2024 versus 2025. We are seeing that, yes, the weaker dollar has helped international markets if you look at the purple component of those returns, but there are a lot of individual catalysts in different areas that have caused a lot of strength in these different markets. Let's take Europe, up about 30% this year. Europe is being driven by an incredible amount of fiscal stimulus that will be deployed over the next couple of years. Multiples in gray have expanded over the excitement over this fiscal spending, but the reality is today is just day one. We have yet to see how that will translate to earnings growth. In addition, Europe tends to be a pretty interest rate sensitive market relative to, say, the US, when you think about bank lending, when you think about shorter term mortgages. So the fact that Europe has been quietly cutting rates while the US has been on pause is a great tailwind to their consumer, to their corporations, to their overall economy. And you can see that in different sectors. as Europe has to become more reliant on its own defense. You can see that in the performance of their aerospace and defense. As interest rates come down and as lending environment improves, you can see that in areas like European banks, which have pretty stable and strong balance sheets relative to where we were a decade ago. Take a look at an area like China. China has had incredible success this year, not because its economy is particularly strong. It is perhaps bottomed, but it is still struggling. But they've made great strides in technological innovation, particularly in areas like AI. And you can see that in terms of where in the market Chinese stocks are doing well. Some of their offshore securities outperforming domestic securities, really as a nod to some of those technological factors. So AI, big story over in Asia. In emerging markets, when you take out China, many areas are still doing well. While it's lagged a bit this year, areas like India have incredible potential when you look at earnings growth, economic growth, demographics, some of the investments, both digital and physical, that they're making in their infrastructure. Areas like Korea are jumping on the corporate reform bandwagon. Areas like Taiwan continuing to be successful from a technological perspective. Latin America has been one of the best performing equity markets this year. Japan, also an area that's perhaps lagged behind some of the other areas, but corporate reform is well underway, and they are looking to deliver for shareholders over time. And you're seeing that in Japanese banks, industrial companies over in Japan, some of those more cyclical areas. Plenty of opportunities outside of the US. It's not just because of the dollar, and all of those catalysts are pretty individual. If one area doesn't quite work out, you have a variety of other options in the international landscape that can do pretty well. So, are people selling America? Are foreigners dumping American securities? That's not what we're seeing. If you look at the chart on the left, we look at the share of foreign ownership of the treasury market at about 25%. Now, that has come down over the course of the last decade, but it's actually risen more recently as the Fed has started to raise rates. So you have seen that investors from abroad have come to the US for that high quality and those higher yields. What you can see on the right, from an equity market perspective, is that 18% of the US equity market is owned by people abroad. Everybody wants access to some of these high-octane technology companies. People want a bite of the apple in terms of these very successful companies and this high profitability. That, again, is an area that has only grown over the last couple of years. And it's not only that foreigners are not selling America, Americans are not selling America either. What you saw in March, in April, in June, is that retail investors were buying the dip. And in fact, the institutional investors, the hedge funds, are only now just catching up as it relates to positioning and buying into the US equity market. So we're not seeing foreigners sell America, we're not seeing Americans sell America, and in fact, in cases, you're actually seeing investors doubling down on the US. So when people say, sell America, end of US exceptionalism, despite the political volatility, the weaker dollar, higher deficits, higher rates, I say not so fast. Now let's think about the future. Where do we go from here? Because the US has a long and storied history of innovation and of translating that innovation into profitability. And we are just in the early innings when you think about the next technological revolution of AI. So let's take a look first back at that history. What this chart shows is the largest companies in the global markets. I've also highlighted in the bottom here the largest companies in Brazil in gray. Brazil has such a rich heritage of companies in the financial, industrials, energy sectors. Itaú, Petrobras, Vale. Deep heritage, deep legacy. And some of these companies, over time, have continued to be the largest companies in Brazil. But what you see on the global stage in those blue companies is they've consistently been US companies, and they have evolved as technology, innovation, and industries have evolved. You went from more energy-oriented companies to more financial services, now to greater tech companies. And these companies have become behemoths. If you look at those individual dots in 2024, they add up to about 20% of the MSCI all-country world. 5 companies, 20% of the index, all US companies. So let's take a deeper dive into those 5 companies. You see some familiar names of those mega cap tech companies. Add 2 more, and you've got the Magnificent 7 stocks. So what you can see on the left-hand chart here is the performance of the Magnificent 7 in green relative to the S&P 500 as a whole in gray and the rest of the market in blue. In 2023, 63% of the returns came from just these 7 stocks. In 2024, 55% of returns came from these 7 stocks. Now, sometimes people see charts like this and think about the dot-com bubble. Are we in for some pain here? We have seen some pain. We saw some pain this year when the Mag 7 were down 25%, but they've regained that ground. And they have economic viability and a concentration in terms of importance that has far exceeded some of those companies in the past. 44% of research and development comes from just these 7 companies when we think about US R&D. A quarter of CapEx, a quarter of free cash flow of the overall S&P from just these 7 companies. 67% of earnings last year, 40% of earnings this year. Now, on that earnings point, you do start to see in the top right there that some of that earnings growth is slowing. The bar gets higher and higher. It's harder to achieve those growth rates. But the good news is we now have options in the US market as well, as the rest of the S&P 500 starts to pick up in terms of earnings growth, and there's more participation of other sectors and other companies. What you can also see on the bottom is that the Mag 7 are not a monolith. You have to be active even within those stocks and make active stock selections. The best Mag 7 this year is up almost 25%. The worst is down about 25%. So not all of them will equally benefit. We do want to be careful about what we own. But what is clear is that these large stocks have a track record of innovation. They're able to translate that innovation into profitability, and that's able to support shareholders. And that has made these companies of strategic national importance. But I mentioned we have options, and increasingly we do, because AI is broadening out beyond just 7 companies. While those 7 companies can still benefit, many other companies are also coming into the fold. So what you can see on the right-hand chart, or the left-hand chart here, is CapEx from the major AI hyperscalers, so to speak. They've essentially doubled the amount of CapEx that they are pouring into the AI space in just the last 2 years. Think about 2023 when the Mag 7 really started to take off. They had been successful in the past. People had started to doubt them, but then this AI story gave them a second wind. Once they started spending, other beneficiaries started to come into the fold. So AI 1.0, think about it as a concentrated number of small innovators that are doing really well. We entered AI 2.0 in 2024, where other beneficiaries started to come in. If you want to build AI, you need data centers. That needs real estate, it needs heating, it needs cooling. It needs to be connected to the grid, it needs sufficient energy inputs. The picks, the shovels to actually make AI come alive requires a lot of physical infrastructure. So you saw energy, utility, industrials companies in the US start to crack the top 10 best performing companies. And in fact, the 10 largest companies were not the 10 best performers in 2024. Only a few of them were. The rest were some of these picks and shovels companies. And now we're heading into AI 3.0 this year, where you start to see on the right-hand side that other businesses are adopting AI to become more efficient in producing goods and services. So you can see in September 2023, across different industries, how many people were using AI and how much that has grown in just 2 years and how much that is set to grow in the next 6 months. as financial services, healthcare services, real estate, law, accounting, manufacturing, start to use these tools to become more productive, that will in turn help their profitability. And again, that's already something you're seeing in the markets. The best performing sector this year in the US is industrials. Despite the fact that technology is still doing so well, the best performers are industrials, financials, utilities, materials. You're seeing it again. For the first time in a long time, it's value and growth in the US, not just growth, not just concentrated growth. And that also gives us an opportunity to find compelling opportunities in different sectors that are not only differentiated, but potentially at lower valuations, giving us also another option from some of the high concentration, high valuation. So AI, while it feels like a concentrated theme, has actually broadened out pretty significantly and will continue to do so, becoming a more and more inclusive revolution, providing more and more opportunities within the markets. And yet, investors will say, but the US is near all-time highs again in the market. So this seems like a foolish time to invest because you'd be defying the basic investment principle of buy low, sell high. And yet there's some nuance to this. What we look at on the left is we look at the S&P 500 over time, and you can see that about 7% of the time we reach an all-time high. So it's not all that frequent. But 30% of the time, when we get to an all-time high, that's the new market floor. We never go below that level again. In addition, all-time highs tend to cluster together. 81% of the time, an all-time high occurs within 1 week of another all-time high. And the reason why that's important is because when momentum begets further momentum, that compounds over time. The chart you can see on the right hand is pretty counterintuitive. It shows that actually investing at all-time highs can sometimes be more fruitful over time than investing on any day. Why does that work? Last year in the S&P 500, we had 57 new all-time highs. Imagine investing in all-time high number 3. You didn't know that we were going to have 54 more all-time highs, but as you rode the market up, those returns do compound, and that does have an impact over time on returns. So investing at all-time highs is not necessarily a bad thing because the all-time highs of today will not be the all-time highs of tomorrow. And in fact, the US has never failed to regain a prior peak and then surpass it. Of course, the market is not without its risks and its volatility, but wow, can you believe that at one point this year we were down 19% in the S&P 500 and now we're up 6%. We have seen a tremendous recovery, but it's less rare than you think. If you look over time, we look at the calendar year returns in the S&P 500 in gray, and then the maximum the market fell that year in red. Over time, the market falls on average about 14%, and yet 75% of the time, that eventual calendar year return ends up positive. So as odd as it feels this year to almost have had a bear market and now be in positive territory, given the risks that we have incurred, it actually very much falls in line with historical experience. The patient investor is often rewarded. Now, how do we manage through that volatility? Because clearly, it's not comfortable to be in a volatile environment, but we do that in 2 ways. We have that longer-term mindset. We create a plan for the long term because we know that there will be volatility. We don't know when, we don't know why, but we know it will occur, so we want to be prepared for when it does come about. So how we construct portfolios is that we are diversified. If we could perfectly predict the markets, we would never diversify because we would know what was going to be on the top or the bottom of this chart every year when we look at a ranking of different asset classes in the market. But since we don't, we have to make sure that we don't put all of our eggs in one basket. So what the white box cutting down the middle of the slide shows is a globally diversified portfolio, particularly one that would be relevant for this region. And despite tasting every flavor of risk this year, tariffs, war, existential threat to AI with DeepSeek, we are in a position where that diversified portfolio is up about 15%. And interestingly, a lot of the unloved areas of the market have been outperformers this year. Bonds across the spectrum, short duration, long duration, different sectors, different geographies. A lot of international markets that have lagged behind the US for years. More of the cyclical stocks as opposed to the growth stocks, which have underperformed for years. It's a good reminder that diversification works when you least expect it and where you least expect it. But it does help you to achieve your longer-term investment goals by giving you a plan and giving you something to hold on to when the ride is pretty wild. So with that, when we think about US exceptionalism, past, present, and future, we've come from a very strong economy in recent years, the miracle of high growth and low inflation. And we have taken on new headwinds, policy, rates, deficits, weaker dollar. And yet, when we think about corporate America, when we think about the ability to innovate, to translate that into profits, when we think about the resilience of the consumer and that willingness to spend, we do believe that there is a long road ahead for US exceptionalism. It doesn't mean we don't rebalance to other areas. We include other areas in our portfolios. We don't want to ignore any options and opportunities in the market. But certainly this is not the last that you've heard for US exceptionalism. Thank you.